Welcome to StokTok's deep dive into Lam Research. Lam Research is a global leader in the design and manufacture of wafer fabrication equipment, the machines that semiconductor fabs use to etch, deposit, and clean silicon wafers at ever smaller scales. At the time of recording, the stock was trading at 267.78, positioned near its 52-week high of 273.5. A move that reflects the rally from a 52-week low of 68.53. The 50-day moving average sits at 235.17, well above the 200-day moving average of 170. A setup that suggests intermediate momentum remains constructive. The RSI, or Relative Strength Index, reads 61.2 neutral territory, neither overbought nor oversold. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Lam Research competes in the semiconductor equipment market, building mission-critical machines used in advanced chip manufacturing. The company's competitive moat rests on decades of engineering expertise, significant capital intensity to compete, and switching costs. Once a fab commits to a vendor's process, transitioning is disruptive and expensive. Revenue flows from both product sales and service contracts over the life of the equipment, creating recurring cash generation. The StokTok score rates Lam Research at 55 out of 100, classified as a hold. Breaking down the 5 dimensions, valuation scores 0 out of 20, indicating significant premium pricing. Financial health scores 19 out of 20, reflecting fortress balance sheet metrics. Profitability scores a perfect 20 out of 20, demonstrating best-in-class return generation. Growth scores 8 out of 20, flagging modest expansion rates. And smart money scores 8 out of 20, suggesting cautious institutional positioning. Let's examine each in detail. Now, valuation. The question every investor has to answer: are you paying the right price? Lam Research trades at a trailing 12-month price-to-earnings multiple of 54.84 times. For context, the semiconductor equipment industry has historically traded in the 20s to low 30s, so this represents a material premium. The forward price-to-earnings multiple sits at 37.72, implying the market expects earnings growth to accelerate, which we'll examine in the growth section. The PEG ratio, price to earnings divided by expected growth rate, comes in at 3.64. When PEG exceeds 2, the argument that the stock is reasonably valued relative to growth becomes harder to make. The EV to EBITDA multiple, a measure of enterprise value relative to earnings before interest, taxes, depreciation, and amortization, stands at 43.84 times. That is exceptionally expensive on an absolute basis. The price-to-sales ratio reads 16.57 times, meaning the market values the company at $16.57 for every dollar of annual revenue, again, well above sector norms. GuruFocus Value, a metric that attempts to estimate intrinsic worth based on various fundamental approaches, estimates fair value at 116.43. At the time of recording, the stock trades at 267.60, implying a margin of safety of negative 129.84%, meaning you are paying more than 2.6 times what some valuation models consider fair. Wall Street analysts at the time of recording have a consensus mean price target of 302, with a high estimate of 385 and a low of 220, based on responses from 31 research analysts. The spread suggests meaningful disagreement on fair value. Market sentiment around Lam Research, as of the creation of this video, leans bullish, scoring at positive 0.72 on a -1 to +1 scale. The narrative centers on strong semiconductor sector momentum, record market highs in technology, and positioning within growing capital equipment demand, particularly exposure to advanced manufacturing initiatives. However, the bear case rests on the observation that the current valuation leaves little room for error. If revenue growth disappoints or multiples compress, downside could be sharp. In our view, valuation is stretched. The premium implies the market has priced in substantial future growth acceleration that may or may not materialize. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that audits financial quality by examining profitability, liquidity, and leverage, stands at 8 out of 9. This is outstanding. The score indicates no red flags in basic financial reporting or deteriorating health metrics. The Altman Z score, a model that combines liquidity, profitability, leverage, and solvency metrics to estimate bankruptcy risk, registers at 22.4. Anything above 2.99 is considered safe, so Lam Research sits well into fortress territory. The cash-to-debt ratio of 1.38 means the company holds $1.38 of cash for every dollar of debt owed, a healthy cushion. Interest coverage, measured as operating income divided by interest expense, reads at 40.53 times. This means operating earnings could theoretically fall by more than 95%, and the company could still service its debt. That's the hallmark of a fortress balance sheet. The current ratio, a measure of short-term liquidity calculated as current assets divided by current liabilities, stands at 2.26. Above 2.0 is generally considered conservative and healthy. The debt-to-equity ratio of 0.44 indicates that for every dollar of shareholder equity, the company carries only 44 cents of debt. This is low leverage and suggests substantial financial flexibility. The clear verdict: Lam Research has a fortress balance sheet. There are no near-term solvency concerns, no financing risk, and considerable optionality for capital deployment, whether that's acquisitions, increased R&D spending, or shareholder returns. Financial strength is unambiguously a core strength of this franchise. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, the profit generated on every dollar of capital deployed into the business, reaches 46.41%. That is elite. For perspective, the S&P 500 averages roughly 15 to 18%. Lam Research generates nearly $3 of profit for every dollar of capital put to work. The gross margin, the percentage of revenue remaining after direct manufacturing costs, sits at 49.80%. This reflects both the premium pricing power the company enjoys and the operational efficiency of their manufacturing footprint. The operating margin, profit from core operations before interest and taxes, expressed as a percentage of revenue, stands at 33.77%. For every $100 of revenue, the company keeps $33.77 as operating profit. That operational leverage is exceptional. Net profit margin, the bottom line, reaches 30.22%. 30 cents of every dollar of sales flows to the bottom line. The free cash flow margin, cash available after capital expenditures, as a percentage of revenue, reads 30.23%, nearly identical to net margin. This means the company converts reported earnings into actual cash at exceptionally high rates, which matters for capital allocation and shareholder returns. Return on equity, the profit generated on every dollar of shareholder capital, reaches 64.3%. Return on assets, the profit generated on every dollar of total assets, stands at 29.74%. These are best-in-class returns metrics. The data screams this is a highly profitable, capital-efficient business. The company operates with significant pricing power and cost discipline. Profitability is unambiguously a major strength and likely reflects the structural advantages the company holds in a capital equipment market where customers face high switching costs and limited alternatives. Onto growth: is this business expanding and at what rate? Revenue growth over the trailing 3 years stands at 2.3%. That is decelerating modestly. Over the past 5 years, revenue growth averages 12.6%. The deceleration from 12.6 over 5 years to 2.3 over 3 years signals a slowdown in recent periods. This is a critical tension. The company is extraordinarily profitable, but growth has stalled. The semiconductor equipment market is cyclical, driven by fab capacity expansion and technology node transitions, both of which are inconsistent. Book value growth, the growth in shareholder equity per share, over 3 years reaches 19.2%. This is higher than revenue growth, reflecting the company's ability to retain and deploy earnings effectively. However, book value growth alone does not tell us if the company is expanding its addressable market or simply optimizing its existing business. The dividend yield stands at 0.38%, which is low and reflects management's preference to reinvest earnings rather than return cash to shareholders through dividends. The data suggests Lam Research is in a growth plateau phase. The company is not in decline, but neither is it expanding revenues at rates that would justify the premium valuation independently. In our view, the growth narrative rests entirely on the assumption that the semiconductor industry enters a new cycle of capacity expansion, driven by AI chip demand, advanced packaging, or other secular tailwinds. If that cycle materializes, the modest recent revenue growth rates could accelerate meaningfully. If it doesn't, growth remains a constraint to the bull case. This is the core risk to monitor. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier gurus and super investors currently hold Lam Research in their portfolios. The Dataroma Guru database, which tracks holdings of the most successful long-term investors, shows mixed recent activity. Triple Frond Partners, which allocates 5.26% of its portfolio to Lam Research, has reduced its position by 30.97%. Chase Coleman at Tiger Global Management, with a 2.25% allocation, has also reduced by 25.85%. On the flip side, Lee Ainsley at Maverick Capital, with a 1.16% position, has aggressively added to the position, increasing by 3,722.97%. David Tepper at Appaloosa Management, with 1.06% of the portfolio in this name, has added modestly, increasing by 14.86%. Christopher Davis at Davis Advisors maintains a minimal 0.01% position with no recent change. The pattern suggests tactical disagreement among the best money in the world. Some are reducing exposure, others are adding. 13.4% of 13F institutional filers, a measure of what professional money managers collectively are doing, are net buyers. For context, 50% would indicate the broader institutional community is bullish. Insider ownership stands at 0.39%, very low. This means Lam Research Management owns almost none of their own stock, which could be interpreted as a misalignment with shareholder interests. Insider transactions over the last 3 months show 0 buys and 5 sells. When insiders are selling, particularly without offsetting purchases, it raises questions about management confidence in the current valuation. The smart money picture is mixed. Some elite capital is accumulating, but others are lightening. Insider activity suggests skepticism. This warrants caution, in our opinion. And finally, the verdict. Let's bring it all together. On valuation, Lam Research trades at a premium multiple well above historical sector averages and above intrinsic value estimates, with the margin of safety deeply negative. The bullish case relies on analyst consensus views that the company will grow into this valuation, but execution risk is real. On financial strength, the company boasts a fortress balance sheet with exceptional liquidity, minimal leverage, and no solvency concerns. This is a core asset. On profitability, Lam Research is a profit generation machine, with returns on capital in the elite category and margins that reflect significant pricing power and operational excellence. On growth, revenue growth has decelerated sharply to 2.3% over 3 years, a constraint that undercuts the bull case unless new demand drivers materialize. On smart money sentiment is mixed, with some elite capital adding but others reducing, and insider activity showing selling pressure at current levels. Our interpretation of the data: Lam Research is a best-in-class business trading at a best-in-class price. In our view, the current valuation offers an unfavorable risk-reward profile for new money. The company would be a compelling holding at materially lower prices, where the fortress balance sheet and elite profitability could justify a premium. At current levels, one might argue the case for waiting for a better entry point or deploying capital to opportunities with more favorable valuation setups. The StokTok score of 55 out of 100, classified as hold, reflects this balanced view. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Lam Research. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.